Jason on today. You on the line, Jason?
I am indeed.
Hi, how are you doing?
Very good, thank you. How are you?
Good, yeah, good, thank you. Great to have you on, especially at the moment and what's been going on. I think we last had you on at the beginning of the year, and everything has changed since then. So it'd be great to get an update from you. We've got about half hour and quite a lot to go through. But do you want to just quickly kick off with a intro of the fund for viewers that don't know you?
Sure, I'll do that. And actually, I'll just give a general few thoughts rather than talk particularly to the slides. But it's interesting you said, we last spoke beginning of the year, lots have changed. And at that time, we probably were saying lots has happened in the previous 12 months.
Yeah.
Real estate in the UK has had quite a rocky road over a bit of time now, from the Brexit vote, obviously through political uncertainty, COVID. We came out of COVID obviously with feeling that things were really looking quite good and quite a bit of optimism, and a market which was functioning really well, getting back on its feet. And then this year has again been pretty difficult. What do? We invest in UK commercial property. We invest in logistics, in offices, in retail, and in some alternative or other space within real estate. So just thinking about that, we very deliberately decided we didn't want to be a focused fund. We wanted to be able to utilise the strength of Aberdeen's research, knowledge and skills and experience to be able to identify sectors and thematics which would support the objective of the company, which is to provide an attractive level of income, along with the prospect for income and capital growth. And that we would then be able to utilise the real estate experience and knowledge to find assets which fit that. So we like to be able to move into different sectors at different times. We've been fairly heavily exposed to logistics for quite a long time. In fact, for over the last 10 years, we tried not to do too much buying over the last 2 or 3 years in that sector because it was quite expensive, and we were happy with what we had. In fact, we took profit in that sector not too long ago, particularly with our smaller multi-let industrial estates, where we felt there was cost pressure going to impact on tenants, and so we focused on the mid-box. We invest in offices. We've actually been reducing our exposure to offices over the last 2 years. Focused very much on making sure that we've got affordable space which has great amenity, really provides a place where people want to work for our tenants. Retail, we've not invested much in retail for quite a while, which will be no surprise to anyone. Where our interest has lied is within retail warehousing. And actually that's just focused really on budget retailers, so very affordable space. Most of our rents are sort of around £10 a square foot. And again, that affordability is really important there. So we want our tenants to be able to make money. We've not bought in that sector for just over 2 years. The prices changed really quite dramatically last year and through the first half of this year, and we just felt that it got to a stage where it was hard to justify, so we didn't buy. We utilise leverage, and I do have a slide which I suppose we should go to on leverage, if that's okay, Richard. We had a facility maturing at the end of Q1 next year, and we were keen to secure an extension to that, which we've done through our existing lender, RBS. Now, I'm delighted that we've got a fantastic margin of 150 bips. We've actually already seen margins beginning to move and terms becoming harder, and a couple of banks have sort of withdrawn a bit from the market over the last few weeks. The bit which isn't so palatable is that swap rates have increased dramatically through the course of this year, and even more so over the last month. And we put this facility extension in place, I think it's about 3 weeks ago now. It's all a bit of a blur, to be honest. It's been such an incredible time. And we ended up with a very high swap rate. So on our term loan, the all-in cost of debt is just under 7%. We reduced the amount of the term loan, and our intention is that we won't be drawn on our RCF in April next year. In fact, we don't have any on our existing RCF anymore. Although the slide says 17 million here, we've sold a couple of assets and repaid that. Our leverage is just under 20%. It's low. We're very comfortable with that, and we just need to work through, this slightly higher cost of debt for the time being. And I guess, one of the comments that's been made by previous speakers is discounts. The company is on a large discount. The whole sector is on a large discount. Interestingly, well, maybe it's interesting. It is to me anyway. I started speaking to some people in the US earlier this week, just to see whether or not the pricing of UK REITs might be attractive to US investors. Could I find some additional buyers for the trust? And I realised that the discounts in the US, even for best in class, were sort of around the 50%, and their yields are actually slightly higher, sort of 8.5% to 9%. Our current yield is around 6.5% to 7%. Our discount is around the 50% as well. A level which is really painful. Obviously, we're not happy with it. It's slightly wider than our peer group, but more or less in line with a lot of real estate funds. We have done buybacks earlier this year. We've continued to look at the opportunity, and we've just been focusing on making sure we don't need to draw RCF at the moment in debt. And quite frankly, although I think that we will begin to see some good asset purchase opportunities in the market, it's very hard to see why one would be buying an asset today when you could buy shares at a 50% discount and a similar or yield. So we'll look at that, and we'll look at repaying more debt as well. Hopefully that gives a bit of an overview. Is there anything else you'd like me to cover, or go into questions?
Yeah, just before we go into questions, I just wanted to talk on and I think there might be a question on it actually, valuations in the sector, which are obviously going to come off. Where do you see that going? I know you had a NAV announcement this week for the end of September, and you reported 4.2% valuation decline across the portfolio. Where do you see that going over the next, say, 6 months to a year?
Yeah, okay. So if I perhaps start with some context, last year we saw significant capital value growth through valuations in the order of about 22%. We saw valuation growth in the first half of this year, roughly 7.5%. And then in Q3, valuations declined. Most of that decline came through in industrial and logistics. Really two reasons for that. One, it was a very low yielding sector, and this valuation movement has really been driven by debt costs, and the primer properties with the lowest yields had the most significant outward yield shift immediately. But also it's the most liquid sector, so valuers were able to see more evidence. And valuation in the UK is done on a comparable evidence basis. There is generally a valuation lag. So because it's a point of inflection, we actually announced that the level of our valuation fall, I think the 4.2%, as soon as we got the valuations in, rather than waiting until the NAV, which was this week. As I say, 4.2%, is at the end of it? No, absolutely not. We anticipate values falling over the next, probably the next 12 months. We're seeing a global re-rating of real assets, and we're not going to be immune to that. I think we're in a relatively good position, and I think it's always very difficult to talk about, we're performing well relative to others when it's negative. It's never a nice experience. But our portfolio generally has slightly more yield on it, and so we've got a little bit of sort of cushioning, I think, from this repricing, which is driven by gilts moving out, risk-free rate moving out, etc.
Yeah. Got quite a few questions come through on the debt, which
I expected that.
Probably expecting, yeah. So, what is the average debt tenure? So it's 3 years. Did you miss the boat in locking low rates?
Yes. Well,
yeah.
we benefited from having very low rates for a very long time. And with hindsight, I rather wish I'd locked in at the beginning of this year. Do you know, 3 years ago, when I was listing what I thought my biggest risks were in the fund, I'd put debt refinance at higher interest rates. And then when we went through COVID, I removed that. The speed of change in circumstance has been quite incredible. We started looking at the refinance earlier in the year, and yes, with hindsight, I'd love to have done it earlier.
Yeah. And with the couple of questions here on the dividend, so with the increase in cost base, are you going to be able to maintain your dividend?
So what I'm not going to do is give a dividend forecast. I can't. It's the board's decision apart from anything else. But my expectation is yes. And why do I say that? Obviously, we know we're going to see an increase in cost of debt, which is going to have an impact on dividend cover. But we've also got some great things happening. On the letting side, we've agreed terms when we're just refurbishing a unit, a logistics unit at a great rent. So that'll come on stream into next year when the new debt cost starts. We're developing a pre-let unit again that comes on stream early next year. We've got actually more of our vacancy, our office vacancy, under offer today than at any time over the last 3 years. And I have my fingers and toes crossed, and I'm touching wood when I say that, because it's obviously, you know, no guarantee that they go through. But all of these things can lead to some fairly significant growth in our rental quite quickly. We have about £6 million worth of reversion in the portfolio. And if we can reduce our voids in line with the space under offer, the deals we've already done, some rent reviews coming through, and these pre-let developments, then that's really going to mitigate the impact quite a bit.
So just on that, what is the what's the impact on your ERVs, the estimated rental value, in your latest sort of now?
The impact of
what in valuations, have they come out or come in?
Yeah, so the ERVs haven't really moved much this quarter. There hasn't really been evidence of change, and we're not seeing it particularly in the deals we're doing. So I think rental values are likely to be maintained and perhaps increase in logistics still. I know that may feel counterintuitive in what we're expecting to be a recessionary environment, but actually there's very, very low levels of supply of logistics. We've got great units, and also the change in supply chain management, I think, is going to be a continued driver of demand as more and more companies struggle with supply chain management from overseas and look to increase either production or storage within the UK. So I think that market actually still will see some rental growth, and we're not seeing any slow up there. On the office side, we haven't yet seen much change, but I think there will be pressure on rents undoubtedly. Now we're positioned in assets which I think are quite affordable, and one of the things we've done is focused a lot on providing fully fitted space which is ready for tenants to move in, so they don't need to worry about capex for fit outs, etc. And we found a certain resilience and higher level of take up because of that. And retail, actually, I've got no reversionary expectations within retail in the portfolio. I just don't see rents growing there, and in fact anything coming back. But we haven't got any vacancy, and we don't have any lease expiries in the near future.
Cool. So last question here on the debt, and then we'll move on. Is it correct that you're locked into debt, your swap arrangement? Sorry, no. Could you have locked it for longer than 3 years?
Yes, we could have done, and we looked very carefully at what the ideal tenor was, and I've got no idea, whether we were right or not. But what we were working on was the basis that it was a lower cost overall, going for 3 years rather than 5. And so with the 3 years, the arrangement costs and the margins, although the 5-year swap rate was just slightly lower, the overall cost to us was less. But also we felt that the 3 years, looking at the shape of the curve in our own house forecast, that will give us the opportunity to lock into lower rates again sooner, rather than locking for 5 years.
Yeah, that makes sense. And what's the average yield on the portfolio?
So the initial yield on the portfolio at the moment is around 4.6, 4.7. Equivalent yield is about 100 basis points ahead of that. So that's where the rents will sort of average out to fairly shortly. Yeah,
cool. And then you mentioned obviously a few sales you've done recently, paying off the remaining of the RCF. Are you planning to do any more sales once that's been paid off?
Yeah, so look, we've always transacted quite a lot within the portfolio. We like to realise profit. We like to rejig the portfolio in a period of time. So, over the last 2 years, we started that process. We exited some, as I say, multi-let industrials and a industrial unit which had huge power usage and poor ESG. A couple of years ago, we've exited out of about 6 offices over the last couple of years. One we just announced this week. There's a couple of things which we're also looking at as exiting out of. Maybe bring the office exposure down a little bit more, and actually, one or two. We think we've more or less come to the end of that for this year. We are seeing a stabilisation in the market. If 2 weeks ago, as I said, we won't be looking to sell anything else because pricing was just so uncertain. And we're beginning already. The last 2 weeks, things seem to be stabilising. We've had 1 or 2 people come back on deals we're aware of in the market, where 2 weeks ago they weren't comfortable about what price they'd paid, and now they can firm up, etc. So we'll continue to monitor it and take opportunities.
Yeah, that makes sense. You mentioned offices there. We've got a question here on what on the office sector. Obviously, it's been a massive talking point in the last few years. Are you still focusing on the turnkey solutions, the sort of fitted out solution that you offer tenants, and what value is that adding?
Yeah, I mean, I'm really keen on that. So if I look at our office portfolio, what's the characteristics of it? Fairly small floor plate stroke suites. So one of the things we're seeing is obviously a lot of downsizing of occupational needs. City or town centre with great amenity, places people want to be able to work in, can get to easily, etc., etc. And we're finding that with the fitted suites, it works at the corporate level, that new tenants who are downsizing, etc. They're looking at the total cost of the move, etc. They don't want the capex, and the worry about how fit out costs will increase, because obviously there's been a lot of uncertainty of build costs. So the fitted suites, when someone goes around and they look at 6 different opportunities, and one of them will cost them nothing to move into, they know exactly where they're going to sit. A very different experience than looking at a fairly grotty place which needs a refurbishment and a full fit out, and they have to think about that rather than how it's going to work for them. So the reason it's worked for us is higher rent, shorter vacancy, shorter incentive.
Yeah, that makes sense. Sorry, I missed a question here on the yield. We were talking about the yield. So equivalent yields around about 5.6, did you say?
Yeah, 5.6, 5.7.
And is that the yield you think API should be at?
Yeah, so that's just the average time-weighted average yield of the portfolio. So yeah, that's probably the best guide. Okay,
cool. I think we discussed this quite probably the last time we had you on about the forest acquisition you made, sort of carbon offsetting rationale behind that. Can we have an update on that and the future of that?
Yeah, so at the risk of sounding pedantic, we haven't invested in a forest. We invested in open moorland, so unproductive land, which we will turn into a forest. So our plan is to plant roughly 1.5 million trees, undertake some peatland restoration, and gather a lot of carbon credits, as well as biodiversity gain, etc. Where are we at? Forestry moves fairly slowly, and the people running it. We are very close to having all the approvals in place for planting and getting the grant funding, with an aim that we can start to plant next year. So we're making really good progress. The market is very strong in that area. And quite frankly, I don't know if this is linked to the question or is a next question. I think as we get all of those approvals and everything's in place, we'll have done the first step of enhancing the value of our proposition. Given that we've got a worse debt situation than we had before, we have to decide whether or not it's appropriate to maintain a fairly large asset which provides no income. Even although over the next 10 years, I think it'll provide fantastic value to the company. One's got to make sure that we make the right decisions. So one of the things I'd say is my general approach at the moment is there's an awful lot going on that I can have absolutely no control on. So I'll just focus on what I can control, which is running the portfolio as well as I possibly can. I've got a great team here. We've got some great asset management opportunities. We've got what I think is a really advanced but sensible approach to ESG, which will create value. And that land is part of it. And I'm not wedded to any one of our investments. Sorry, I like the investors. I'm not wedded to any of the investments. We'll try and make every decision on a rational basis, based on the information which we have at hand. And I think I've used the word hindsight a few times today. I wish I had it. It would make decision making much easier.
Yeah, yeah. Should we then talk then about the bit about the portfolio and where you see it going? So you obviously massively in logistics at the moment. Have you? And you said you see rental growth there, but obviously you see most of the valuation decline there. Have you got plans to lower the exposure to that sector, or?
Not really. So, I mean, we actually have just sold an asset earlier this month, which was our lowest yielding asset in the portfolio. We sold it at a yield of 2.84% at the beginning of this month. And that's one which had performed really well with us. And actually, I think it's really, one of the things that struck me as the sale was going through, a slightly emotional period for me. And it's the first asset I bought for API, or SIP as it was at the time, in the fall of 2007. So I'd been in the fund for about a year at that point. And I thought it was really nice asset at the time. Obviously, a year later, so sort of late 2008, I was rather questioning what on earth I'd been doing buying an asset. And yet it's been one of my best performers over time. And that becomes to me a real reminder that, real estate is a longer term asset class. I shouldn't be looking at valuation movements over a quarter or even a year. What I'm looking at is, do I believe that this unit is going to, or the investment will work over 3 to 5 years? Is it a property which is going to continue to meet occupiers' needs, continue to provide a good income stream, and meet the needs of the company over time. And I look in the logistics space, and yes, it's seen the most valuation move yet. Does that mean it's going to be the most valuation move over the cycle? Probably not. I think other sectors will catch up and probably surpass. So very happy to keep a higher exposure to industrial.
Cool. And then a question here about the geography of the portfolio. So about a third is in the north. Is this a risk or a hedge against greater economic downturn in the south?
So I'm almost ambivalent to location within reason. And what I mean by that is what I really want is an asset which works in the location and is going to continue to appeal to tenants. So obviously a location which works well for logistics may not be the same for an office. So I don't really have many offices in the northeast. I don't have any, but I've got some fantastic manufactured stroke logistics units. So one which we got under offer today, subject to refurbishment, is becoming a logistics unit. It was used for manufacturing before. So the northeast, the northwest is really strong for industrial. Our offices actually are more focused on the southeast town centres and Birmingham, again in the city centre. So it's horses for courses.
And then vacancy rates, they're coming down, you mentioned. Biggest in the office portfolio, is that right? Yeah,
so actually vacancy rates have reduced. They're just about 9.5% at the moment, although we've got one asset has been pre-let, so we need to finish refurbishment and then the lease will start. That'll take it down into the 7s, and then with the other offices we got under offer, hopefully down into the low 5s. So voids, I'm pleased to say, are moving in the right location. It's obviously been a pretty tricky time for letting space, particularly in offices, over the last 2 or 3 years. We feel as though we've got some traction at the moment. The logistics, we've got very little space left to let. We've had a couple of really great lettings this year.
Cool. And then last one on this. You've got other there, alternative sector. What is your holdings here, and have you got ambitions to grow that?
Yes. So other, I've got a data centre. I've got a couple of leisure assets. One of which is a cinema and View, so they pay their rent now, and then we've got Wetherspoons, Nando's, McDonald's, Sainsbury's, and a small 99p shop. So it's one where we're really helping with the health of the UK, but trades its socks off. It's in a great location in North London, and we've done a lot of work on planning for a massive redevelopment of the site in the future. So it's quite an interesting sort of leisure stroke alternative use play. So that's how what we've got in other at the moment. Would I like to increase it? Yes. I think it's a really interesting sector, particularly within living. So maybe some apart hotels, student housing, etc. With the type of thing which we're quite interested in there.
Cool. All right, we've sort of come to the end of the time, but last question, just with the mini budget coming up, what would you like to see come out of that?
Stability.
Mini budget. Stability, yeah.
Yeah, I mean, look, I'd love to see someone sort out business rates on real estate, commercial real estate. I don't see that happening, and it's certainly not in the mini budget. I just think we need to have a period of calm.
Yeah, amen. Yeah, cool. Okay, well, yeah, thanks for coming on and giving us a run through again. That's really interesting, and yeah, we'll hope to have you on again maybe in a year's time and see how it's all going again then.
God willing. Thanks, Richard. Have a great weekend.
Cheers, you too.
Cheers, bye.
Cool. So that just leaves me to say what we've got coming up. So we filled the hopper for the end of the year, and then just wanted to highlight first week in January with Andrew not Andre, Andrew will be back with James to do a roundup of 2022. So we look forward to seeing you then and again next week. Thank you.